100th day of the Trump presidency. So the timing of this presentation impeccable. We're still awaiting our first trade deal. Fingers crossed that we can, take this from a self-inflicted setback to something a little more productive. But it's hard to be predictors of such, and it's our job to just be stock pickers and really to find the best stocks that can sort of weather the storm and help us over time and grow the dividend as an income trust. So let's move on to the slideshow, please. And I'll try to keep this quick. I know that we're running slightly behind, but the capabilities at Janus Henderson, I think everyone here probably knows the Henderson part. I think the Janus part, equally important. Tremendous depth of research. It shows 37 analysts supporting myself and Jeremiah running this fund. I think what's important here is the analyst track is very much a career track at Janus. So, there are people with 10 years experience, 20 years experience, 30 years experience that are analysts. We have over 30 billion in research fund assets under management. So you can make a career, you can get compensated properly if the analyst role is your mindset versus a portfolio manager role. And for a portfolio manager like myself, it's a tremendous resource to have analysts with that sort of depth of knowledge, as well as the younger analysts, which are tremendous, and they bring something additive to the table as well. But very in-depth research, which I think really underpins the whole process here at Janus Henderson. Overview, and this may look small on your fund on your screen, but essentially this is a growth and income trust. It pays a proper dividend. The dividend right now, with a modest discount, is roughly 4%, growing at sort of a mid to high single digit rate. I would tell you the securities in the portfolio on average yield about 3.25%. Those stocks are growing their dividends roughly mid to high single digit. Earnings growth is also in that mid to high single digit range. We believe that those ranges can be exceeded, but in the sort of the cause for conservatism, we sort of frame it as sort of a mid to high single digit type of growth rate for both dividends and earnings with that proper dividend. And then I think importantly, as investors in the U.S., the big pushback I get when visiting shareholders and potential investors is valuation. And I think Emily mentioned it earlier, valuation matters very much. The cost of capital is no longer free. The access to capital is no longer easy. We think valuations matter. And the average valuation in this fund, of this average stock in this North American Income Trust, is roughly 15 to 16 times earnings, not the 20, 21, 22 times headline earnings that you see, but rather something a bit more modest for pretty good growth. So we believe it's growth and income at a very reasonable price. So why large cap equities? There's a whole bunch of reasons why we think large cap equities are well positioned. But given the sort of volatility that we're seeing right now, I think I'll bring up a couple ones that are maybe perhaps less obvious. One I sort of just mentioned indirectly, at least, was self-financing. I think companies that have the wherewithal to not have to lean on the capital markets right now are very well positioned at a time where capital markets are a bit skittish. We've seen some good days followed by some tricky days. But markets are not easily accessible. The price to get debt financing is a lot more expensive than it was a few years ago. So I think self-financing and this portfolio as an income trust focusing on free cash flow generation, self-financing, very important. And then something else that maybe isn't important today, but very much will be important in the next month or two is supply chain management. And for better or worse, COVID gave a lot of our companies and a lot of companies globally a look at their supply chain and a way to optimize it and maybe step back from just-in-time supply chain to something where you have more than one, sole sourcing becomes dual sourcing, if not multiple sourcing. So I think with large cap companies, especially the ones that we're invested in, the higher quality ones, you see a lot of sourcing focus, a lot of supply chain management, and those discussions are going on right now. And I can tell you that every one of our analysts who are out meeting with companies and fund managers alike are talking about supply chain much more than they would have perhaps historically. This is a little bit further on why the U.S., why large cap. I think with the U.S., I think what you're getting, and this isn't new information for many of you, but you're getting that entrepreneurial culture. You're getting less regulation than perhaps in other geographies. You're getting the access to capital, whether it's venture, all the way up to public equities, for an investor like myself. But having that access, having that framework, that governance construct, I think puts the U.S. in a very good framework. And then obviously low taxes is the final impetus. So we feel very good about the U.S. Perhaps a lot to talk about, maybe some questions about the current state, because the current state's been a little less predictable than it has been historically. But we feel pretty good about that. And then why large cap, I think, we've just talked about that on the previous slide. U.S. dividend growth. So this is the Janus Henderson Global Dividend Index. It shows U.S. growth. U.S. growth rate of dividends has been incredibly strong for a long period of time. Of course, if we were all in the room together, the pushback would be it comes from a lower base. That's factually correct. The U.S. is not a big dividend culture. The S&P dividend is currently less than 1.5%. I think I've told you earlier that the North American Income Trust, the stocks in our portfolio, yield north of 3%. But importantly, the growth rate is very strong. And then if you sort of look at that kink in the middle there during COVID, very few dividend cutters. I think what the U.S. is a balance of dividends and a balance of share repurchase as far as return of money to shareholders. And what you saw during COVID for many firms that have this balance is shutting down the share repurchase lever and just focusing on dividend and dividend growth. And in the North American Income Trust during this period, we only had one dividend cut. It was a very small one, 14%. We still own that company. We've owned that company for 7 or 8 years now, and that company is paying a higher dividend now than it had done pre-pandemic and during the pandemic. And this is the dividend track record of the North American Income Trust. The trust was converted in the middle of fiscal 2012 from a tracker trust. It is now an equity income trust for the last 13 years. We've raised a dividend every year. We became a next generation dividend hero after our 10th year. And I think importantly, we put money to reserves all but 1 year during this period. And the 1 year we didn't was when we had reached that full 1 year of revenue reserves. So we passed that entire balance through. But needless to say, we have a very good track record. The board is committed to a progressive dividend, and revenue reserves right now are approximately 14 months. This is our approach, and I'll try to keep this quick as well. But the flexibility, it's a large cap focused fund, but we have the ability to go into mid caps. We have the ability to go to Canada as part of North America. But suffice to say, it's a quality focused portfolio. We're looking for the best names that fit the remit, and the remit is obviously high quality and dividend growth. And within quality, strong balance sheet, strong management, high barriers to entry, everything you would expect. And as far as selectivity, it's very much a best ideas portfolio. So right now we've been running the portfolio 47, 48 names currently. So very much a best ideas. And we always have, a dozen, 15 names sort of on a watch list. And I tell you, quite honestly, during this period of dislocation over the last month or two, we've actually been able to pull off some of these high quality watch list names that traded at fairly high valuations that had derated, we believe, unfairly, and added them to the portfolio. So it's something that, we have a best ideas portfolio, but there's always that list of really good companies, whether they're trading at full valuations or whether they're duplicative to the existing names in the portfolio. Something we're always looking to improve the portfolio. It's very much a living organization, if you will. And then expertise, scar tissue. It's the market can be unforgiving. I think we have it. I think self-reflection is important. Humility is important in this seat. And we've seen a lot. And I told you the analyst team is also very tenured. They've also seen a lot. And I think that is probably the most important thing when you look at experience. It's not a linear bull market, but something where we've seen lots of give and take and 10% corrections and 20% corrections and learning from that. Sort of here's what we look for and a bit of a schematic, and maybe I'll use some examples, in some of these. So strong competitive advantage is listed first. The name, and there's a lot of names in the portfolio that I can point to each one of these, but Home Depot is a name that I think that many people will know. High quality retailer. It's something that it's a bit out of favor right now, which is why we've been adding to it from a small position to more of a mid-sized position right now. But an incredible balance sheet, and a couple things that maybe differentiate it is their access to the professional. The professional has always been a tough person for a big box retailer to get. Half their business now is professional, and they've really made strong inroads, and having that quality, having the access, having the supply chain to have the product on time at fair prices, really balances the portfolio for them. So it's not just a consumer discretionary purchase, but a very much professional repair and remodel, which makes it a bit less cyclical as well. So that's sort of an example of a competitive advantage, in the name of Home Depot. As far as growing end markets, one that may not be obvious as well is company Texas Instruments that we've owned for quite some time. I think what's interesting about Texas Instruments is they have semiconductors that go into applications that are more traditional, so automotive and a lot of industrial applications. So very much, the real economy, if you will. And what we've seen is cars obviously add more semiconductor components over time. We've seen this in the industrial and the factory floor. So it's something that even though those industries in and of themselves are somewhat cyclical at times, you see sort of a secular tailwind of more semiconductor components in those. And Texas Instruments is sort of the best in class name. We feel very comfortable with them and their cash generation. Return on invested capital, a couple names come to mind here. Philip Morris would be a name that you would know. They invested heavily the last 5 to 10 years in their reduced risk products, as well as a timely acquisition of Swedish Match. And I think that if you look at them now, they're beginning to harvest that. So highly free cash flow generative, high returns on invested capital, and they're being able to harvest that surplus cash flow and reinvest it properly, and obviously pay a proper dividend. One that may be a little bit obvious is a company called Trane Technologies, HVAC manufacturer. But what's interesting about them is it's not just selling the HVAC devices, machines. It's a service and consultancy where over a third of their business is higher margin sales service. I use the phrase consultancy as far as new builds and whatnot, trying to optimize the footprint of an HVAC machine, but just general aftermarket sales, very high, very predictable, very recurring, less cyclical than a typical industrial for that. And then as far as cash flow and liquidity, it's really all the names in the portfolio. This is a focus on high free cash flow, proper levels of investment to be sure, and a fair growing dividend. So we feel very good about the portfolio, sort of on all four of these, but especially from a cash flow and liquidity perspective, given the remit of the trust. And this insight, it really speaks to our research team, and I'll just give you a couple quick examples. Detailed financial models. Every company here is modeled very thoroughly, and I think what was interesting probably for you to hear is in the last month or so, we had those detailed models, and we had every analyst flex every name in their portfolio for a recession type scenario, and just sort of put some framework around that, which allowed us as fund managers to put sort of a valuation framework around potentially lower earnings, which is something that obviously is important because lower earnings would usually beget lower cash flows, and as dividend growth investors, that's something that would be very important for us. So that's an exercise that we've done. We've made some decisions based on that. Most of this was companies that we've owned for a long time, so it wasn't a whole bunch of new learnings per se, but it did add some framework, and it did show companies that maybe had done very well the last few years maybe had a little farther to fall than companies that have just sort of been a little more consistent. So something a healthy exercise to do, and something that our analyst team was able to do in very quick order. And then sort of trends and insights. Again, the best example here, and I wish I could show it, but would just be looking at the calendar. Our analysts are on the road all the time. It's earnings season right now. So, if you look at the calendar, you'll see analysts. We've got a bunch of earnings for every analyst. We have a whole bunch of follow-up calls, often with C-level executives, whether it is CEO or a CFO. And I would tell you, we get that access because we're large, high quality, long-term shareholders, and we get the access. The dialogue goes both ways, and I think it's good for us. It's good for the companies just to sort of hear. We're not looking to trade a stock around a quarter. We're really owners in this, so I think that's important. And then I think the travel. I think the team's road warriors. We're all road warriors. If you were to look at the calendar, everyone's out meeting with companies, meeting with suppliers, meeting with competitors, really trying to find that edge and really be experts in their field. This just shows our sector snapshot, fairly basic. It shows that in a nutshell, we're sector aware from a risk perspective. We need to have a well-diversified portfolio. That's something we've always done. But in times, if parts of the market are overvalued, we tend to lean the other way. So we're a bit contrarian on that front, not overly dramatically so, but we've had material weights at zero, we've had utility weights at zero, we've had large overweights in other sectors. So it's something that we're cognizant of, sort of the cyclicality and the consistency of the portfolio, but valuations and fundamentals really will dictate where our weightings go, and that's our job as fund managers, is to construct a properly weighted portfolio, hopefully optimizing the risk budget. A productivity slide. I'll be quick here. Productivity is improving, and productivity is something that probably comes up more so every couple of years. It's come up a lot now, with higher inflation, higher tariffs. How do these companies, get sales and turn sales into earnings that they have all these margin pressures? So AI technologies is something that's talked about all the time at our firm, and it's not how many Nvidia chips will Nvidia sell. It will be, hey, can one of our banks use AI technology to lower expenses by 100 basis points? Can our consumer packaged food company um, optimize ad spend by reducing spend and doing a thorough analysis using AI tools to do it in a quick and efficient manner? Can they price things in an optimal manner and not always have to discount to drive that incremental bit of volume? And then healthcare is another maybe less obvious, but obvious for me being part of these discussions. Just trying to attack disease states in the most efficient way, in the most efficient use of R&D dollars. And that's something that those discussions happen with companies. And quite frankly, I tell you, after earnings season, we'll meet with these companies and really deep dive into that. When we talk to companies, it's not a recap of what they said at the last earnings call. It's really longer term thinking, understanding the way that they're investing and the way that they're incented. And this is just some examples of healthcare for disease states and sort of the use of technology um, that can help, work through these. So I'll keep that. You can read that on your own time. But let's continue the slides and shortly get to questions. And next is our performance slide. Next slide. Trailing 12-month performance over a series of years, something that you can all surely find on your own. But we feel pretty good about the portfolio here. And I think after a period of large cap growth stocks at very high multiples doing well, we feel very good having sort of this growth at a reasonable price. I told you earlier, most of our stocks, the net multiple is somewhere between 15 and 16 times, growing at a low double digit rate. That earnings growth could come down a bit if there is a recession, and perhaps we can talk about that in the Q&A. Dividend growth in that mid to high single digit range, but again, a very well constructed portfolio and very much a best ideas at 47, 48 names. And I think it's time for questions.
The first question I've had come in has been about the earnings of the companies in the portfolio.
Yep.
And the weighting to US domestic versus international. And can you talk about that, please?
Yeah, I think when you look at it, the market has shifted over time. So it used to be a little more balanced. It's been a little more US centric. Some of that can be double counting on, and we don't own Apple, but iPhones that round trip. But we probably lean a bit more US centric right now, but we own multinationals. It's a mix, and it's roughly 60% US, 40% international. It's something that we consider from, we own Coca-Cola. They've recently reported earnings. They hedge currencies. So that, the story there is a little bit different. The angle of the question could be from a tariff perspective. That's something that we would obviously consider. And the deep dives we've done on tariffs have been incredibly thorough. I mean, we've had entire meetings for multiple months. And I think in the beginning, I think a lot of people thought the exercise was, well, isn't Trump just doing this to cut a better deal? And the answer was perhaps, but let's do the work now so we don't have to chase it later. And I think that's really been instructive. And for us with the tariff rhetoric and the trade wars is we need to be cognizant of that. We've taken some portfolio actions, but I would tell you the actions aren't very dramatic. I think they're more on the margin. It's leaning into some positions, taking them down where there's a little bit more tariff risk and being comfortable to increase them where there's a bit more. And obviously with valuation as part of that framework. So, we are aware of that, of the international business mix, but I don't think it's good or bad in a vacuum. I think it's something we're cognizant of. And obviously it would be sector by sector would have differentiating points of an international business mix.
The next question does refer to sector. The question is asked, the US doesn't have the same culture of dividend payments as we have here in the UK. Are there any particular sectors that are higher dividend payers, or do you see commonalities, I guess, within the companies in the portfolio that make them more, where you see the higher dividends being paid out?
Yeah, no, I think it is very much a sector by sector basis, and I could probably even simplify it a little more. If you look at sort of maybe what I would call the defensive sector, so maybe consumer staples, healthcare, utilities, they tend to have higher payout ratios, more modest, predictable earnings growth. And for them, you see a little bit of higher dividend yield. Technology, industrials, typically lower dividend yields, a little more cyclicality. I would tell you that in those sectors, if you look at the cyclicality within the sector, we tend to look for the more consistent, predictable business models, as you would expect as dividend investors. But those may be the lower yielders. Those may yield, 1.5%, 2%, 1.25%, that we would look at more as total return candidates, and then obviously flanked by some of the more defensive, more predictable names, and create a diversified portfolio. And importantly, we're not trying to have the highest yielding portfolio. We're trying to find that mix of growth and income. So, some lower yielding stocks, some higher yielding stocks, net that out to something north of 3%, that dividend growing at a pretty healthy clip, 6 to 7% historically. And I think it's a pretty compelling, story that we have there as far as dividend growth.
Next question is about US debt. US debt is growing apparently out of control, according to some, and could set off major problems and market crash. What would be your view on this, and what plans do you have should this come to pass?
Yeah, no, I mean, factually correct. The debt levels are higher than they have. And, historically, the U.S. has, been the reserve currency, which gives a dollar strength. That hasn't really proven right now. It's proven over time, but right now the proof point has not, been active. So that's something that worries us. The government's obviously cutting back on spending. There's GDP implications on that. There's employment implications on that. So I think for us, if you look at our portfolio, I wouldn't say it's overly offensive or defensive, but I think within these sort of the more cyclical sectors, we are a bit more defensive. Our beta is less than one, if you will, and beta is never a perfect predictor of future, direction of the portfolio. But we are aware of that. We are cognizant of that. I mentioned we did stress test the earnings models of our companies. But you did see, and I hasten to bring up the name Musk, but government spending, came out of COVID at a very high level, understandably, but during the past administration never really came back to normal, really just stayed at that high level. And I think that's the part that needs to be addressed now. And the phrases detoxing the economy have been used, and other phraseology. So I think it's something where, it's a tricky one, because rates again aren't 0 or 1 or 2%. It's 4s and 5% if I look at the U.S. Treasury curve. So it's something where Trump and more importantly, Beston is keenly aware of this. And there's little bits that may be able to help on the margin. If you're a bank and you hold treasuries, you have to hold surplus collateral for that. So if you remove that regulation, which really doesn't make sense, maybe there's an increased demand for treasuries, and maybe that pushes prices down, or yields down and prices up. So, things like that the government's trying to think about without, resorting to sort of bad tactics that really just kick the can down the road, as we've seen time and time again.
Next question. What is the link between dividend and total returns for stocks?
How do we view them? Or
Yeah, I guess the question is asking, with the well, that's a good question. I'll think about it and I'll come back to you. Let's move on to the next one. Do you believe Trump's tariffs will reduce US national debt?
I'm not looking at that as a pure revenue generator. It obviously is bringing in money right as we speak. And if and let's say the tariffs get rolled back to that 10% universal tariff or something, more modest or more manageable, that will help on the margin. But it's still very much an income tax oriented. That's really where the big deltas will come. That's where the revenue is going to come in, from income taxes. And quite honestly, this may not be known to everybody, but it's personal income taxes that really drive the U.S. tax revenue basis, whether it's income on wages or whether it's income on capital gains, versus corporate tax collection is actually very, very low. And the rates are a bit lower, 21%, and obviously the mechanisms to expense and get sort of bonus depreciation and whatnot, allow you to reduce that. But something that the tariffs will be a component of that, but it's going to be it's not going to be the big component. And the tax policy, which sunsets at the end of this year, most of it, especially on the personal level, it's something that needs to be addressed in the next month or two, and you'll get a lot more answers on that front. But I would not expect, nor are we expecting, tariffs to be the heavy lift there.
Next question. With political instability, are there signs of companies cutting or indeed even increasing investment in response?
Yeah, I think the supply chain's going to be the big question now. So, we're finishing earnings season. The calendar, as I keep mentioning, we're going to be on the road meeting with companies, and that's the question. It's really the supply chain, the gaps we saw in COVID. set a lot of companies back several quarters, if not years. So, they've added capacity, they've added, multiple sourcing. So those are the questions that we're looking for. And luckily, our companies being cash generative, not needing external financing for the most part, have the ability to invest and play offense at a time when many other companies are playing defense. That's perhaps overly simplistic, but those are the questions that we really want to attack. And luckily, and I guess there's nothing lucky to come out of COVID, but if nothing else, supply chains were addressed pretty thoroughly a few years ago. So they will be tested again, and we're going to find the answers to that shortly.
Okay, the question of the dividend question has rephrased, and they've said your objective is probably total returns over the long run.
Yep.
Do high yield stocks lead to higher total returns?
Yeah, and I would say that we're not, the way I look at it, again, this is a simplistic view, but we're sort of looking at maybe above average dividend yields with above average dividend with inline sort of dividend growth. So, I mentioned dividend yields of something that nets out north of 3. If I showed you a list of all my stocks, it starts around 1, it ends around 5. It nets out to roughly 3. The growth rate is very healthy. It's very comparable to the the index at 6 to 7%. So we've been able to sort of cherry pick those sort of growth and income names. So if you think about long-term earnings growth, and we'll just say 7-8% to be a reasonable proxy. If we can get sort of 3% dividend and maybe 7% earnings growth and sort of have a 10% total shareholder return, assuming no multiple expansion, be very conservative on the multiple front. We keep those 15 net multiple. That's sort of our story. Again, it's not exciting. It's not, you wouldn't want to go to a cocktail party and necessarily brag about that. But if we can be consistent and sort of have that 3% dividend, with a mid to high single digit earnings growth, that's sort of the in aggregate, sort of what we're trying to do, and do it at a fair price. If you want to have a sort of a fast portfolio that can double or triple, there's other trusts that better address that. But this one hopefully will live up to its remit and pay a little bit of balance of capital and income.
Okay, final question. This one came in right at the start, so I wanted to make sure we got through to it too. Could you help us understand how the options generate income for the trust, as these make up a large proportion of the dividend income and cover the associated risks?
Yep. So option income it's actually a pretty small part of us. If you look at the revenue slide, and I didn't put it in the slide deck, but historically dividends are 75 to 80% of total revenues. Option income has been 15 to 20, and then sort of residual cash interest is the balance. But option income, a typical use of an option, first of all, it's not a covered call portfolio, so let's get it. Let's take care of that off the bat. If you look at our option sheet right now, there's probably 6, 7, 8 options. Typically, 2 or 3 calls, 2 or 3 puts would be something normal. And really, what it would be is we've decided that we're going to say top up a name 50 basis points or top slice a name 50 basis points. We can either put that order through to the trading desk. The trading desk executes that often immediately, or we can say write a call, maybe $1 or $2 out of the money, collect some income, and use that as a means to trim a position. And put would be the exact opposite. It would be writing something $1 or $2 out of the money, getting some income to do so. And the only reason we would use the options would be if let's say in the call example, if we feel pretty good about a company's fundamentals, we think valuation's a bit full, but fundamentals are very strong. We know that valuation in the short run is a very poor predictor of stock prices. So maybe we'll write that call, and get a little bit of income. So it's something that's very much on the margin. It's sort of surgical in nature, but it's additive to the fund, and it's been between 15 and 20% of revenues over time.
Okay, that's terrific. Fran, thank you very much indeed. Thank you for joining us.
Welcome. Appreciate it. Thanks for your time.